Hello, today we're breaking down what's better, investing or trading. In this video, you'll find out the key differences between these two strategies, their pros and cons, and which one might be right for you. Stick around to the end to learn how to choose your path and avoid losing money in the stock market. Support the channel with a like and a subscription. As soon as you step into the world of the stock market, the first question hits you: trading or investing? Two approaches, two paths. Fast deals or patient waiting. At first glance, it looks like just a matter of style, but in reality, it's two different lifestyles, two ways of thinking. That's where we'll start. Trading is all about movement. Fast, intense, and full of pressure. Picture this. You're in front of your screen, dozens of charts open, prices jumping up and down, and you're trying to catch every move. That's trading. Money is made in minutes, sometimes even seconds. A trader is always looking for chances to profit from price swings. One day they're buying the dip, the next they're selling into strength, and then jumping back in again. Trading demands total focus. You've got to monitor the market constantly, make snap decisions, stay cool and emotionless. Every percent counts, every moment matters. It's a job that requires focus, discipline, patience, and nerves of steel. But despite all the speed and action, trading is not a shortcut to easy money. There are no magic strategies giving you 300% a month. What you've got is hard work, technical analysis, and constant adaptation to a changing market. If you're ready for that, welcome aboard, but there's another way. Investing is about patience, calm, strategy. An investor doesn't chase quick wins. They're thinking long-term. They look for companies with growth potential, evaluate their business, analyze reports, strategies, and competitive advantages. Only then do they buy and hold for years. Investing is a long game. You don't need to sit at your screen for 8 hours a day. You can work, run your business, relax, and still make money. Your money works for you. The company grows, the stock goes up, and dividends come in. Time is your ally. Join our Telegram channel where we post announcements for new videos and articles. You'll find the link in the description or pinned comment. If trading is an obstacle course, investing is climbing a mountain. Step by step, slowly but steadily. That's how Warren Buffett, Peter Lynch, and John Bogle made their fortunes. They didn't chase charts. They invested in real businesses, their substance, and their future. Still, the goals of traders and investors are very different. A trader wants to make money here and now. Fast. They're looking for the moment. They ride the wave and jump off before the crash. They're not building a portfolio for decades. The goal is to find the entry, grab the profit, and exit. An investor thinks differently. Their goal is to build capital, collect dividends, stay stable. They're not afraid of temporary drops in stock prices because they know in the long run, strong businesses grow. So this choice depends on your personality. Are you impulsive? Do you like speed, thrill, and challenges? Then maybe trading is your thing. But if you value stability, analysis, and long-term thinking, investing might be the better fit. And that leads to a bigger question. How do these approaches work over time? Trading is about short distances. A trade can last an hour, a day, a week, sometimes even a minute. The key is to catch the move and get out before the market turns against you. Time is risk. The longer you hold a position, the higher the chance of something going wrong. Investing works on a totally different time scale. Months, years, decades. Patience is the name of the game. You don't buy an asset to cash in tomorrow. You buy it for the growth it can deliver down the line. Sometimes it takes years, but it pays off. Now let's talk about how traders and investors actually analyze the market. Traders use technical analysis. It's all about charts, patterns, support, and resistance levels. They don't ask, is this company any good? All they care about is the chart. If there's a signal, they're in. No signal, they wait. Technical analysis is the art of reading charts. Like a doctor diagnosing from symptoms, traders read candles to see trends, reversals, breakouts. It's a visual language of the market, and you've got to know how to read it. But here's the thing. No indicator gives 100% certainty. It's always about probabilities. Investors take a different road. Fundamental analysis. They dig deeper. They look at financials, profits, revenue, margins, debt. They study business models, competition, and industry trends. Their goal is to figure out what a company is truly worth. And if the current price is below that value, that's a buying opportunity. Fundamental analysis isn't about fast results. It's about understanding, confidence, and picking assets that will grow with the economy. That's how you build a strong investment portfolio. But trading isn't just about pretty charts. It requires serious risk management. Traders often use stop-loss orders, preset price points where a trade automatically closes to limit losses. Think of it like a seatbelt. If something goes wrong, you don't lose everything. Traders also have target levels, places where they plan to lock in profits. This kind of risk control helps manage losses, curb emotions, and stay disciplined. Still, even with great strategies, trading is risky. One wrong move and you can lose a big chunk of your capital. That's why trading demands strict discipline and constant self-control. Investors face risks too. Their biggest fear: choosing a company that doesn't live up to expectations, or investing right at the top of a bubble when everything's overheated. The key here is diversification. A well-balanced portfolio can weather storms, reduce volatility, and protect your capital. We've got a new article up on our website. You'll find free content on stocks, bonds, and ETFs for everyone from beginners to advanced investors. Check it out and bookmark the page. A true investor knows how to wait. Stay patient. Don't panic during a dip. It's not always easy, but those qualities lead to financial freedom. Now imagine combining the flexibility of trading with the depth of investing. Yes, you can do both. In fact, many people already do. They put most of their capital into long-term investments, solid company stocks, bonds, ETFs. That's the foundation of the portfolio. Then they use a smaller portion for active trading, crypto, derivatives, individual stocks. That way, they profit from short-term moves while still building long-term wealth. This hybrid approach takes skill and discipline, but it offers both flexibility and reliability. The key is not to mix the two strategies. Money meant for investing, don't touch it when things dip. Trading losses, don't turn them into investments, hoping they'll bounce back one day. So, which strategy is right for you? It depends on your goals, your personality, and your time. If you want fast results, can handle risk, stay focused, and deal with stress, trading could be your thing. But be ready to learn, lose money, and make mistakes. If you prefer stability, don't want to spend 8 hours in front of a screen and care about peace of mind, go with investing. It's a path that takes years, but the results are steady and predictable. You can also be both. For example, invest 80% of your capital and trade with the remaining 20%. It all comes down to your routine, your knowledge, and your risk tolerance. But either way, you can't skip learning. Financial markets never stand still. New tools, new algorithms, crises, reports. If you're not evolving, you're falling behind. Learn to read charts, learn to analyze companies, watch how the market moves, what ideas are working, and how the pros operate. Study technical analysis if you want to trade. Learn about levels, candles, volume, momentum. Understand them and you'll understand the language of the market. Study fundamental analysis if you want to invest. Financial statements, ratios, forecasts. That's your toolkit. Knowledge gives you an edge. It turns gut feelings into systems, randomness into patterns, emotions into logic. Remember, the stock market doesn't reward ignorance. The winners are those who understand, not those who guess. Learn something every day. Read, watch, analyze. Only then will you stop guessing the market and start truly understanding it. Smash that like button and subscribe to the channel. Support our content on the membership platform. Links in the description or pinned comment.